Welcome to Business Innovators Radio, featuring industry influencers and trendsetters sharing proven strategies to help you build a better life right now.
Hi, welcome back to another episode of Business Innovators Radio. This is your host, James Hamilton Healy. And today we're talking about one of my favorite subjects, money. Well, actually, we're talking about real wealth building strategies that really work for real people. My guest, Nick Jensen, the Financial Cowboy, is no stranger to hard work, rough play, and working with folks to create wealth and hold on to it. He's a former bull rider turned business and financial professional who helps people create strategies that allow them to eliminate debt, build wealth outside of Wall Street, prepare for a tax-advantaged retirement, and leave a family legacy. Thanks so much for joining me, Nick.
Hey, thanks, James. I'm glad to be here.
Awesome. So tell me just a little bit about the Financial Cowboy and how you are helping your clients.
Yeah, good question. So as you mentioned in the intro, former professional bull rider, that was several years ago back in the day. And after that career, going to school and getting into the finance world, I've been kind of through the gamut of everything that Wall Street has to offer. And started some businesses, made a bunch of money, lost a bunch of money. And through all that process, have gained some valuable knowledge to help individuals really learn how to build wealth. The kind of wealth that the richest and wealthiest families in America build, not the kind of wealth that Wall Street wants to think you can have by investing in the products that you see on the media and touted by, I guess, financial entertainers, if you will. So really solid base strategies that are long-term and really allow individuals to implement them step by step without taking tons of risk.
Gotcha. So I like that, financial entertainers. That's pretty funny. So what is like one big problem that you specialize in solving? Like something that almost everyone is going to have, right? That they're going to run across. So many people have problems with money from the get-go, right? We're just not, I don't think we're educated early on as children even. So
yeah, I mean, that's a great question. So there's a couple things in there. One of the things, I think the education that we receive oftentimes around finances comes from the media, right? And the things that the media touts are what they're getting paid to tout. It's marketing budgets. It's who's paying us dollars in order for us to get the revenue that we need to, have our shows on the TV or whatever the case may be, right? So when you think of the media and you think of the things that we're learning or where we're learning those things, and it's not just TV, it's radio, it's the magazines and things of that nature. All of those dollars, if you really trace those back, those are going back to Wall Street, or they're coming from Wall Street, right? So the idea is, and what a lot of people, when I say a lot of people, what everybody faces is, where do I put my dollar? When I earn a dollar, where do I put that dollar in order to accumulate more dollars? Well, Wall Street wants you to put it with them, whether that's through a brokerage account or through a government-funded or government-sponsored 401k or 403b, which has its issues and problems, but that's probably a story for another day.
Right.
Those are the choices you have. Where do I put this dollar? And so the thing that everybody faces is, without understanding true financial principles and how to really build wealth, they go straight to Wall Street. And they go to either a mutual fund or an exchange traded fund or buying stocks or bonds or something of that nature. But that all goes back to Wall Street. Well, why is that? How does that benefit everybody? Or how does that benefit the investor? You've got the potential to make money if you know exactly when to buy and when to sell, and don't get wrapped up in all of the emotions, which studies have been done that's nearly impossible to do. But the problem is Wall Street is going to collect fees from you whether you're making money or not. And that's how Wall Street exists. And when I say Wall Street, I'm talking about money managers. I'm talking about mutual funds. I'm talking about financial advisors like myself. I'm talking about big brokerage firms. The way that they make money is by charging you fees, whether you make money or not. And so that's the problem that everybody's facing is how do I get my capital to grow without it being chewed up in fees and not taking on too much risk. So it's kind of this risk and control thing, right? You want to take on the least amount of risk as possible and have the ultimate amount of control as possible. And what everybody faces, or the challenge that everybody faces when they go to Wall Street, that's completely opposite. They take on the ultimate amount of risk and have the least amount of control. Right. So the idea is, how do you get around that? How do you solve that?
There you go. I mean, that is a huge fear I know that people have, that of, first of all, like, I don't know what to do with my money. And so I'm just going to pay these fees and just put it in the hands of someone else. Right. But then they're fearful that how do I know that they're doing the right thing? And well, I don't see any substance from that over time.
The problem is you don't know if they're doing the right things. Think about it this way. A popular company right now is Apple, right? Everybody, if you say Apple, everybody knows what that is. If you've got the iPads, you've got the iPhones and things like that. So think about this. If you've got $10,000 or $100,000 or $1 million, it doesn't matter. The dollar amount doesn't matter. But let's say that you go to your local brokerage firm and you hand them a check for, let's just call it $100,000. And you say, I want to invest this in Apple. Okay. So when you look at the risk and control spectrum, you hand your brokerage firm that check to invest in Apple. You have zero control over the outcome of that investment. You're beholden to the board of directors at Apple making good decisions. You're beholden to Tim Cook not doing something stupid or scandalous. And Apple itself continuing to add value to the marketplace in which people want to continue to buy their products and therefore increase the value of the company. So you have zero control over what happens there. And because you have no control, you're at the ultimate height of risk, if you will. Because let's say that Tim Cook does something stupid, or let's say that that Apple is no longer able to add value to the marketplace and the stock plummets. You've got the ultimate amount of risk. There is nothing that you can do as an investor to affect the outcome of that investment. Zero. There's nothing you can do. You could sell, right? You could sell your investment for a loss if you want, or you could hold on to it and hope that it comes back. But there's nothing that you can do to affect the outcome of the way that Apple performs.
All right. So you're talking about staying away from Wall Street, right?
Yep.
In a big way. And then what are the advantages of staying away from Wall Street, of kind of the strategies you like to talk about? And then how do we get started doing that?
Yeah, good question. So here's the advantages of staying away from Wall Street. It goes back to risk and control. By staying away from Wall Street, and Wall Street has its place. As long as it's in the proper context and invested in at the appropriate time, it has its place. What I'm against is that's the first place that everybody goes, and that's really the last place everybody should go. Okay, so the advantages of staying away from Wall Street are this. If you do it properly, the way that I build out strategies for clients is I follow this framework that I call the wealth haystack. And think of it as a layered approach, right? The first thing you do is you invest in the bottom layer. The bottom layer, you're going to have the very least amount of risk that you can have with your money, and you're going to have the ultimate amount of control over your money. Once you build that layer out and that layer is solid, only then do you go to the next layer. And the next layer above that, you're going to allocate a smaller portion of your portfolio to that layer, because what you don't want to have happen is if something happens in the above layer, let's just say the above layer collapses, you don't want it to affect the layer below. You always want to have this solid foundation, this solid base. So layer number 2, or the second layer, is hard assets, things you can touch, things you can feel, things you have control over. Because when you go to that second layer, you're going to be taking on a little bit more risk. There's no doubt. You're also going to be giving up just a little bit of control. That's inevitable. But you're doing it at the appropriate time. So the next layer is hard assets. And hard assets, there's mainly two that I tell people to invest in. One is real estate, because we know when we look at wealth and the way that wealth has been built and wealthy families and generational wealth, real estate is a huge component of that process. So one of the hard assets is real estate, and cash flowing real estate, meaning that it's creating revenue for you. It's not necessarily investing in real estate to just hold capital, as an inflation hedge, but actually investing in real estate that kicks off a cash flow to you. So that's number one.
Buy and hold rental properties or something like that.
Rental properties, storage units, apartment buildings, farmland. If you know how to, create cash flow from farmland, ranches, things of that nature, things that you can touch and feel. If the economy completely collapses, you have a hard asset that is worth something, right?
Right.
So that's number one. The second thing is business, and not just any business, but your business. So it's one of those situations where it's kind of this business / invest in yourself scenario, meaning that if you start a business, you have a lot of control over the outcome of that business. Yeah, there's going to be some factors out of your control, but you have a lot of outcome as to how that business is going to perform. If it's not performing well, there's things that you can personally do to try to help that business perform better, right? And so you are taking on a little bit more risk, but here again, you have a lot of control over what happens there. So that's that's mainly the other second component in the hard asset piece. So you've got cash flowing real estate and you've got businesses. Those are the next two things that you would invest in.
Now, you're not talking about if someone's investing in their own business, it doesn't have to be a large business, right? This could be a home-based small business, right? Because that's going to have tax advantages, much like real estate does, right? And that's a big piece of how you help people hold on to their wealth is through the tax advantages created by real estate and your home business or a small business, correct?
Yeah, there's tax advantages to real estate, and there's tax advantages to having your own business. There are going to be different tax advantages, but yes, there are tax advantages to both. And you're correct. It doesn't have to, when you think about your own business, it doesn't have to be this big, elaborate 500 employee company.
Right.
It could be a side hustle. It could be a home-based business. It could be, a network marketing business if you want. I mean, I'm not a huge fan of that industry, but it can be anything like that would allow you to generate more revenue and give you some tax advantages, but also allowing you to have control over what's happening versus not taking on too much risk. So yeah, you're absolutely right.
Right. And you never know what's going to happen with your job or with your health or something like that is out of your control, much like you're saying, where all of a sudden you lost your income source from something that's beyond your control. But if you had that side hustle or a small business or something that suddenly you could grow if you had to, if it was, a proven business model that was working, you'd be in a much better position, right?
And you're 100% right. And that's one of the misconceptions or one of the fallacies that we live in today's society. Oh, I've got a good job, I'm secure. No, you're not. Go ask your neighbor who's been laid off before. One day they think they're doing, they're secure and everything's going well. The next day they find out that the job that they've just spent 10 years at laid them off. And now they've got to kind of reinvent themselves or regroup. So yeah, you're 100% right. You never know what's going to happen. And so having your own type of business, whether it's a side hustle or a part-time business, is definitely advantageous. And I would encourage everybody, regardless their situation, I would encourage everybody to have something in their hip pocket that allows them to generate extra revenue.
Yeah, definitely. I couldn't agree more. And I do feel that it's one of those misconceptions that you're safe in your job and it's scary to start a side business. But I think once someone gets into that and they realize that it's not that hard to start a side business, I mean, it can be something as simple as, plowing driveways in the winter. So, I don't know. It depends on what you have, right? It's like,
yeah. I mean, look in the marketplace and say, okay, what are my particular skills? Where can I add value in the marketplace? And then start a business around that. So I've got a good friend of mine. He loves mowing lawns. It's kind of his solace. It's what he likes to do. 2 or 3 years ago, he started a lawn mowing business in which he just put out some flyers, that he's got this business out there, and if they're interested, give him a call. Well, the first year he got pretty busy. The second year he got really busy, and then he added aerating, and then the third year, all of a sudden he's pulling around this trailer with his logo on it, and it's got these big riding lawnmowers.
Right.
Yeah, he's got a full-time job, but he started this side hustle that if he's not careful, he's going to have to make a choice. Do I stay with my full-time job, or do I just grow my own business?
Right.
Simply because he liked to mow lawns.
Yeah, I know someone who started a cleaning business. Again, these service businesses are really easy because people need this all the time. And she got so busy and so many referrals. Like, she didn't do any advertising or anything. And all she did was maintain the clients she really liked to work with and raised her prices a little bit. And it was like the perfect side hustle. And she didn't want employees. She didn't want a big business. She just wanted to keep that little side hustle gig and keep her good clients. And it could grow to a real business if you wanted it to. Like, if she lost her regular job and that's what she needed to do, it wouldn't be hard to do.
Sure, absolutely. And here's a little tidbit. If you want to grow your business and you want to grow the economic value of your business, when you get to the point where you have to expand, just raise your prices.
Right.
Because as you raise your prices, all of a sudden your value goes up and you're going to be able to make more money doing the same amount of work, or you're going to get busier because now all of a sudden you're more expensive. So people feel like you're more valuable and your client base increases.
Yeah, exactly. So do you see some of the most common fears that people face by keeping their money out of Wall Street, so to speak, like keeping it in a more controllable fashion? The real estate, it's overwhelming for them? Is that what you have people with? Is this overwhelm of trying to figure it out?
Yeah, good question. I mean, it depends on the individual. It can seem overwhelming, but it's like anything else. If you haven't been there before, it's scary, right? Mm-hmm. Our mental capacity, our minds, where do we always revert to? We always revert to what's comfortable, what's familiar. Well, in our minds, from an investing standpoint, what is comfortable? What is familiar? Well, investing in my 401k is comfortable. My HR department's talked about it. Everybody else does it. The stock market, that's familiar. I understand. I buy a stock and I sell a stock. If the market goes up, I make money. If the market goes down, I lose money. That's comfortable. That's familiar. So do people have some apprehension about maybe investing in hard assets? Yeah, a little bit, because unless their family has done it or they know somebody else has done it, there are some things you're going to have to learn. And when you look at real estate, there's so many different aspects that you can invest in, right? You could just go a turnkey property. So you could find a provider out there, and there's a ton of them that offer great value that allow you to buy a piece of property, and then they'll manage that property for you. So you basically are buying the property, they're putting tenants in, they're sending you rent checks every month, and you're paying them a fee to do so, right? You can go from there to all the way up to a pool type investment, to where you've got 4 or 5 or 50 or 100 investors taking down a large project. So there's so many different ways that you can invest in real estate that, yeah, some people have mental blocks on what that looks like, and maybe they don't want to deal with it. But there's ways around all of those scenarios depending on how dirty you want to get your hands, right? If you want to get your hands really dirty, then you flip houses, right? Like you go buy the biggest piece of crap house in an okay neighborhood and you start swinging a hammer.
Right.
And then that's a way that you can make money that way. So yeah, I mean, there are some apprehensions there, but do you mind if I finish kind of the structure, the wealth haystack structure?
Yeah, I'm sorry I got off of that.
No, you're good.
Questions.
So, and I'll go through it quickly. So layer number 2 is hard assets, right? So real estate in your own business. The next layer is alternative investments. So these are investments that you're going to lose some control, meaning you're not going to have any control over the outcome of that investment, but they're not tied to Wall Street. So let me give you a couple examples.
Yeah.
Maybe it's an oil and gas lease type venture. So it's a land lease on oil and gas in which you've invested in this oil and gas scenario, which has tax advantages, by the way. Just being invested in oil and gas, there's some certain tax advantages to that. And then you're collecting a check, assuming that, depending on the type of investment, if it's a land lease, you're going to basically collect a check because they're renting the land from you to drill for oil and gas. Or if you invest in actual oil and gas production, that's a different type of investment. But it's not tied to Wall Street, right? It's an investment outside of Wall Street. So that's one example. Dude, another example. This is interesting, and you can get creative in the alternative assets space. I know a guy who was lending money on semi trucks. So he did it one time for a friend, and then word got around. So it just kind of grew and perpetuated. So, and I don't understand the semi truck business 100%, but I'll give you what I know. My understanding is in order to buy a semi truck, you can either go to the bank and get a loan, or Peterbilt or Kenworth will finance the truck for you, right? Gotcha. Well, yeah, it's probably like auto financing at the dealership. It's going to be a little bit higher, or you're going to pay a premium for that financing, right?
Yeah.
So what this guy did is he filled the gap for people that couldn't get a loan at the bank, but really couldn't buy their own truck by paying 12, 15, 20% in order to buy that vehicle, right? So what he would do is he would require a down payment. I can't remember how much it was. He would be the first lien holder on the truck. He would get the insurance on the vehicle, and he would require a truck payment and insurance payment every month from the new owner, right? And if a payment didn't show up, he would go and repossess the truck. He said he never had to go repossess a truck, but he ensured that one, the title was in his name or in his business's name. Right. Two, there was insurance on the vehicle because he got the insurance, or he made the insurance, made sure the insurance was being paid.
Yeah.
And then three, they were paying him at a fair interest rate. So they were paying more than they would have to pay at the bank, but not as much as they would have to pay, assuming they did it through the financing company. Wow. So that's alternative assets. That's another
okay,
thing.
Quick question then. They made me think of something. Microlending, does that fall under the alternative assets, where someone could get into a similar kind of situation, but they're only lending, $600 or something? Like you don't have to, but you get back $800 or something. Like your return on investment is pretty big, but your output to begin with is small, so it's not going to set you back.
Yeah, so like Lending Club is kind of popular right now. You can invest $1,000, $5,000, whatever you want to do, and then you can say what type of investments you want to be in. That would be a type of alternative asset, right? Okay. You're losing control over what's going to happen, and you're taking on a little bit more risk, but it's not tied to Wall Street. But here again, every layer you move up, a smaller portion of your portfolio is being allocated to that layer. So let's say that in the alternative asset piece, all of your money was in Microlending or a Lending Club or whatever the case may be, and that completely went away for some reason. Every investment you invested in went away. Well, you still have your hard assets underneath that, and you still have your base layer underneath that. Okay. And so your base layer is cash equivalent type savings accounts, right? And then the last piece would be market-based investment or like venture capital type stuff. Complete. Like you don't have any control over what happens. and you're taking on the ultimate amount of risk. So it's one of those situations where you just have to know any money you put in there, yeah, you've got potential to make money, but you also have the potential of everything to completely go away.
It's mad money. It's like when you go to Vegas.
Yeah.
Yeah.
Like, I mean,
I could lose this money, but it's not going to bother me if I do. It's just more for the fun. And if I win, the reward is really cool.
Yeah. And I mean, I'll be the first to admit the stock market is attractive. It's appealing.
Yeah.
Like one of the things that I love to do is trade futures. I don't do it anymore just because I'm busy doing other things, but it's an attractive thing to do. Like I enjoy doing it because of kind of this rush. You make a lot of money really fast and then you can lose a lot of money really fast, and being able to try to time the markets and things like that. That's exciting. The problem is when you look at that long term from just a regular investor standpoint, the number of people that get ahead is slim, none, and zero.
Right. And is that getting harder with computer algorithms doing a lot of that kind of forecasting and trading and futures and
I don't know that I would argue that it's getting harder. You just have to be more sophisticated as to what you're doing. I mean, computers, they can always look at technical analysis and things like that, but they can't really computers can't gauge the sentiment of the market, if you know what I mean, like the emotions of traders and things like that. They're going to see those emotions through technical indicators, but I think there will always be a place for somebody actually executing a trade.
Right.
Not to say that you can't make money with AI type computer-based trading.
Right.
It's just, what do you want to put your money in?
Right. And this is, probably well beyond your average, family guy with 3 kids and a job and a side hustle. I mean, he's pretty busy. So
and
right?
Here again, you're 100% right. I would never tell any of my clients, hey, you should start day trading futures, or hey, you should start putting money in this computer-based trading. Right. If they're at the point where they're like, hey, I've just got so much money, I don't know what to do with it, I think I want to go to the stock market, then it's going to be more of okay, let's look at some legacy type stocks. And when I say legacy type stocks, look at it like a value type investment. When the market crashes, when there's blood in the street, let's look at some companies that have historically paid fairly decent dividends. Let's buy those companies up. And then it doesn't matter if the stock goes up, down, or sideways. Hopefully we're going to get a dividend off of that. But it's not a situation in which we're buying, hoping or praying that the market goes up, because if it doesn't go up, we're going to lose all of our money. We're not doing that, right? So it's just a matter of, okay, where's some value out there that pays some dividends, that we can hold some cash, knowing that the tax advantages of doing stuff like that are not very good. And so when you kind of think about this hierarchical structure, I know multiple millionaires that go to the second layer, real estate and their own business, and that's as far as they go. They don't invest in anything else but those 2 things. Right. And they make gobs and gobs and gobs of money. Right.
Yeah.
Because they understand how to do it.
Yeah, they know it. And so it's easy to scale it out a little bit, right?
Yep. And it's all about acquiring as many assets as possible. Because when you start to look at this from a generational standpoint, it's this idea between the finite game and the infinite game, right? So Simon Sinek did a TED Talk back in 2015 on game theory, and he talked about this finite game versus this infinite game. Mm-hmm. I think oftentimes we look at investing as a finite game, meaning defined players, defined rules, I've got to win. Mm-hmm. Whereas an infinite game is unknown players, unknown rules, and I got to stay in the game. And staying in the game is I got to acquire enough wealth that not just for me to retire, but to set my kids up, and then hopefully to teach them that they can use that wealth to create more wealth and set my grandkids up, and so on and so forth. Then this wealth just perpetuates down the ages, and 4 or 5 generations down the road, all of a sudden your last name is synonymous with the Rockefellers.
That'd be nice.
Yeah.
Hey, so I was just thinking as you were talking about that too, and about how different people might just stick with a couple different layers within the haystack or whatever, but it's situational dependent on when someone is going to move past that first layer up to the next layer, right? They're going to depend, like I'm saying, I guess, depending on the size of their family or what their goals are or how old they are or that sort of thing. And that's probably where you help folks, you coach them on when they can kind of move from one layer to the next, or because otherwise it might be hard, for someone to know when am I done building my first layer?
Yeah, I mean, that's a great point. And that's exactly what I do. When I bring on a new client, it's all about sitting down and figuring out, okay, what are you currently doing? What are your biggest pain points? And what levers can we pull to help you be more efficient? And so that all boils down to, okay, looking at the base layer, where are we at? What do we need to add to that base layer in order to move to the next layer? And by knowing what that is, then we can determine when to move to the next layer. And this is all about building wealth, right? Because the idea is once you build the wealth out, you've got to, when you hit retirement, you've got to then reverse that and start to take an income from that wealth. So it's a strategy of building it all out. Then when you hit retirement, taking the cash flow from it. And then the third piece is when you die, because unfortunately we're all going to die at some point. How do I efficiently pass that on to the next generation? So it's all about how do you do it, timing of when to do it, being able to strategize on what that looks like, and making the current dollars that we have become the most efficient.
Right. Wow. So now can I take a step back and let you tell us a little bit about what inspired you to become a financial strategist? Or I guess that's what I might call you, because you're really helping people create these strategies. Isn't there a story? I think you told me about your grandparents' farm where you worked or something, and how money was mismanaged, and that led you to see that important things could be lost if you weren't taking care of that haystack, so to speak.
Yeah, good question. So, like I said, I grew up on my grandpa's farm. So he homesteaded it in Idaho, and throughout my youth and well into my early adulthood, Grandpa had worked really, really hard on his farm and had built this farm up and created a great living and a great lifestyle for himself. Through kind of a transitionary period of him, I don't know if he was completely retired, because I didn't live around there when this all went down, but whether he was completely retired or retiring, through some mismanagement of the farm, the finances in the farm, and maybe some banking practices taking on too much risk. Ultimately, in the end, he lost the farm. When he was either about to retire or he had just retired, he was forced to sell the farm and forced to sell everything. When I say they, Grandma and Grandpa, had they built out a proper financial strategy and a proper financial structure, they wouldn't have had to take on this type of risk. They wouldn't have had to get into a position in which they had to leverage the farm in order to either grow it or build another business. Or I don't understand all the details behind what happened. All I know is the farm was leveraged in the sense that they had to get rid of it because everything collapsed. But had they built out a proper strategy, meaning built out layer number one, had their savings, opportunistic capital, if you will, in a very safe vehicle, and then use that capital to fund the farm rather than going to the banks to fund the farm,
right?
Then that wouldn't happen, right? Because as trouble in the market, if you will, came, they would have been using up some of their own capital rather than the bank's capital and the bank calling notes, if that makes sense.
Yeah, no, totally get that. Yeah, so that's why
I should probably go back and figure out the exact details, but I think there's some heartburn around it that
I'm sure
if I ask too many questions, I may get shot. So
yeah, no doubt. Well, I mean, as you talk about creating that family legacy, and that is probably a tough one for the family to not have that farm anymore.
Sure. I mean, all of our memories are, as I grew up, all my memories are there. And I'm not saying that the family would still be on the farm because maybe people moved on, but the fact that, he had, I don't know when he homesteaded. He was young. He was just barely married, maybe a couple years. So, he fought World War II, or he was in the military in World War II. And I think he was married then. So, he was there probably 50 years. And then at the end of 50 years, it has to be liquidated because of some bad financial decisions in the last couple of years is sad. When, whether people were on the farm or not, had it been built out properly, he could have passed that legacy on to the next generation, who then could have perpetuated it.
Right. Now, it's never too late to start your haystack, right? I mean, if someone's thinking, man, I'm just too old, I don't know. What do I do now? I don't have time. Because I feel like a lot of people are starting to get to that point in this country where it's just like they haven't thought about this until it's almost too late. And all of a sudden there's medical problems and everything else. But what's the easiest way for anyone to get started?
Yeah, so I think the easiest way is you have to take action, right? You have to do something. It goes back to the old analogy. When was the best time to plant a tree? Well, 20 years ago. Okay, well, when's the second best time? Today. Right. It doesn't matter if you're 20 years old or 70 years old. You've got to do something. And everybody in between is going to be at a different stage in life, and therefore their strategy is probably going to look a little bit differently. The strategy for a 65-year-old with no assets versus the strategy for a 65-year-old with a ton of assets is two different strategies, right?
Yeah.
And so in the same thing on down the ages, a 40-year-old would be the same way. So the easiest thing to do is, if you want to do it on your own, you've got to become educated. And until you become educated, you're just basically shooting in the dark, right? If you're in a position where you're like, you know what, I know I need help, but I don't want to do it on my own, but I need some guidance. That's when you reach out to somebody that you can trust, that you feel like is going to give you good financial advice. And understand the financial industry is riddled with financial advisors that are only interested in themselves, or they're only interested in peddling certain products, right?
Right.
So you've got, there's already the stigma that you feel like you walk into a financial advisor's office and it's like a used car lot, right? Don't let them out the door, type scenario. And that's not the environment you want to be in. So, there's tons of free education out there that you can go to. You can go to thefinancialcowboy.com. I've got some blog posts. If you want to know more about the Wealth Haystack, you can go to thefinancialcowboy.com/haystack. You can download the PDF on the Wealth Haystack. That'll give you a structure you can start to follow. Mm-hmm. And if you want specific help, for your specific situation, go to the website and feel free to schedule a free consultation with me. I'll be really honest with you. During that consultation, if I can help you, I'll tell you what that looks like. If I can't help you, I'll, probably either tell you I can't help you or refer you to somebody that I think can. But at the end of the day, you've got to decide, do you want to tackle this on your own, or do you want some professional advice to help you tackle it? And I understand that the stigma, right? I understand that people are skeptical with financial advisors, because at the end of the day, I'm a wealth strategist, but it's all kind of grouped under the same umbrella, right? And so I understand the skepticism, but I'm happy to have a conversation if somebody needs a little bit of advice.
That's awesome. And you also have your podcast that people can listen to a lot of your strategies and get a feel for who you are, and they can learn. And like you say, it's got to take some education, some self-education sometimes. So, and that's the Financial Cowboy. We can find it on your website.
Yeah, you can go to the website, thefinancialcowboy.com/podcast. and that'll have my podcast on there. And yeah, it's a lot of financial advice. Sometimes it's me ranting and raving. So I hope you're okay with that. But yeah, you can go there. You can connect with me on social media. Twitter, I'm at Finance Cowboy. Instagram, The Financial Cowboy. Facebook, The Financial Cowboy. So you can connect with me on social media and see what I'm doing there. But yeah, I'm happy to help out any way that I can. Understand that I'm super busy just like everybody else. Yeah. So if I don't get back to you in 5 minutes, don't sweat. I'll get back to you as soon as I can.
That sounds awesome. And I'll make sure all those links and all the info are in the show notes for this episode. And thank you so much, Nick. I'm glad I'm working on my haystack, but I do wish I would have started it when I was my son's age. He's only 5. So
Don't we all?
Right?
Yeah.
So, all right. Well, take care, and we'll be in touch.
Thanks, James. Appreciate it.
All right. Bye.
Thanks for listening to Business Innovators Radio. To hear all episodes featuring leading industry influencers and trendsetters, visit us online at businessinnovatorsradio.com today.